The following program has been pre-recorded and is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, the tax lady from EG Tax, wishing you a wonderful end of the Thanksgiving holiday. And don't forget, about a month from now, we're going to be looking at 2024. So you better listen to Ask the Tax Lady, and we're going to give you all kinds of tips and things that you should know to reduce your overall tax liability. And of course, I'm joined in studio per normal with Christopher Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher, and Tiffany Fabian.
Hey, happy Saturday.
You got all your drumsticks eaten?
Oh, yeah. Everything was delicious, and we're so
let's see.
blessed.
This being Saturday, now it's just dried up turkey that's left.
Yeah.
Well, now you can make your turkey soup, your turkey pot pies.
Now you can
sandwiches.
make it. Now you can make it. Okay. I'm Esther Gulius, the tax lady. We're not taking phone calls this week. We're doing this segment. We're doing your emails. So next week we'll be back answering your phone calls. But this segment here today, we're just doing emails, which I think are so interesting because you really get a chance to really dig into everything. An interesting thing, I was looking at the internet, and there was an article on 5 countries that have no income taxes. So one of them is Bermuda, so everybody can be packing their bags. Then Monaco, the Cayman Islands, Bahamas, and UAE, United Arab Emirates, and then another one, Qatar and Oman. That's 7. So if people are trying to get out of paying taxes altogether, that's where you would go. So
Well,
I thought that was interesting.
Yeah, in Bermuda, though, you might just disappear.
Why?
Bermuda
the
Triangle.
Bermuda Triangle. Okay.
Bum, bum, bum.
And I just want to put a thing out there, too. Don't forget, for our listeners, we are doing Toys for Tots. We do have a bin at our office if you want to drop off a new unwrapped toy that goes to a great cause, and we'd greatly appreciate it. Thank you.
That's true. At our corporate headquarters at 1890 Colvin Boulevard.
Yeah,
Correct.
The 3 that we bought are in the bin right now.
After Chris played with them.
Yes.
Okay, so let's do our first email. Who's it from? Read it.
Jordan, Esther, can you explain the 1099K thing this year using Venmo? My tenants pay rent through the app, and I also get reimbursed for family and friends for dinners and movies that I pay for my credit card to get points. Jordan, Esther, 1099K.
Okay, so I mean, they are now keeping track of third-party payments that people are receiving because not everything is just like Jordan, where he's going to be claiming the income anyway as on a Schedule E. Now, if you're getting third-party payments, they're going to make sure that you're claiming this income, because if it's more than $600 in a year, you're going to be getting that form 1099K, and on it they're going to be looking for you to report it on your tax return. Well, if it's rental, you've already been reporting it, I'm assuming, on your Schedule E. The thing that's a fly in the ointment is when you get reimbursed by your buddies when you go out to dinner, when you Venmo them back and forth, that income will also be included. You have to make sure that you can peel that off so that when you're reporting it, you can report part of it on your Schedule E and part of it is non-taxable under the first section of the additional income, and then you take it as an expense to offset it in Part 2 of that section, explaining that it was a personal reimbursement. I would suggest, probably in light of this, that people stop using Venmo for moving money around for personal expenses, because you're going to have to keep track of it and prove that it was not for business.
Right,
You
right.
guys, would you agree?
Yep, and with a month left, now's the time to go through your transactions in a little notebook, your notepad on your iPad, your phone, wherever you do your Venmo, and start separating personal to business to rent, because it could be payments if you have a small business too. People get money that way as
And it
well.
could be all
Garage
listed-
sales.
And it could be all mushed into one. It could be rents, reimbursement, and a small business. So you have to make sure that you're keeping track of everything. Maybe you want to use Venmo for one kind of transaction and maybe PayPal for another kind. So keeping track of the bookkeeping is a lot easier. You know, keeping it simple, stupid is a really good policy, especially when you have the burden of proof is on you. Remember when there was what was it, COVID, and nobody was working and all this kind of stuff. The IRS also was short-staffed, and so they weren't coming after people. Well, I'm going to tell you, they're coming back in full force, and you want to make sure that what you put on your tax return you can prove.
Right, for sure. So and
that's
this
the 1099-K coming to a mailbox near you, right?
Yes.
Okay, let's do another one here.
This says, Joe says, Tax Gang, I've been doing my own taxes for years. Then I got a bill from the IRS for $20,000. I came to you and discovered that the stock I moved around was taxable. You guys fixed it. I owed less than $1,000. This is just a word to the wise. Thank you, EG Tax. I'll never do that again. So
that happens all the time. I had a guy here not long ago whose daughter was in college, and he didn't know that he could, because she borrowed the money, he didn't know that he could take the American Opportunity Tax Credit on his personal return. So we amended his last 2 years' return and put it on this year's return, and it was a change of about $7,500. That's a lot of money.
Oh, yeah. And so what it is that the IRS assumes that you got that stock for $0, and that's called your basis. But really, Joe here, he paid something for the stock, and so his basis wasn't zero. It might have been $19,000. So the gain was $1,000, or maybe it was $2,000.
And don't you agree that a lot of times it's tax terms? In other words, I will say to a client, "Did you have any stock sales last year?" And they'll say no. And then I look at their brokerage statement, and there were sales. And you say, "Well, actually," they go, "No, there was no sales. They just moved it around."
Yeah,
Right? Moving it around means it's a sale.
that's right.
So, tax terminology can also leave you wanting when it comes down to those love letters. So the important thing is, when you get a letter from the federal or the state of New York, or any other taxing administration for that matter, come give it to us. There's no charge for us to take a look at it. We understand tax lingo and what they're doing, and we will help you.
Yep. It was just like when we were at that IRS seminar and they were talking about crypto, there's a certain lingo that surrounds crypto. And so you've got to learn that whole entire new lingo,
Right. And believe me, they're going after crypto people. And they're also going after people that did the
ERC.
That's right, the ERC, because there's all this abuse. So the employee retention credit, which absolutely is in the law, but you had to really qualify. So a lot of these TV commercials, if you notice, there aren't any anymore. We're saying about the employee retention credit and how you have to be very careful. I'm Esther Golias, the tax lady from EG Tax. We're not taking phone calls today. We're just answering your emails. We're going to take a short break and be back on the other side with you, your comments, with Tiffany Fabian, Christopher Fabian. Hey, thanks for listening. We'll see you in a minute. Hi, I'm Esther Golias, the tax lady from EG Tax. Today is email day. Don't call us today. Just listen, because we're chewing up emails. By the way, if you have a tax question, you can go to our website at egtax.com, ask the tax lady, and you can put your questions in, and we may use your email in one of our upcoming segments. But today, I got Tiffany Fabian, Christopher Fabian. We're full of turkey, and we're proceeding. And by the way, what are you thankful for? This being the Thanksgiving season.
The country, well, God, my country, my family, and the country we live in.
How about you, Chris?
Well, I don't want to be a copycat, but ditto. Even though some people may be going, you're thankful you live in this country. Well, I got to tell you, we have it far better. We've seen it. We have it far better than a lot of other countries out there, even though we're in disarray right now. We still have it pretty good here in the U.S., so don't take it for granted.
It is remarkable, though, how so many of the things that I learned growing up about hard work, about that I'm a girl, and you're a boy, and all that kind of stuff. It's just turned upside down. Now, what is a woman, and what's right is wrong, and hard work, who wants it, and all that kind of stuff. I mean, and then our budget deficit. Gee, Miss Crimenezer, it's going to bite us in the butt one of these days. And the thing is, people's way of solving the problem sometimes doesn't seem to be working, and you'd think that they would change their position.
And I just had this great elderly Jewish couple in my office a couple weeks ago, and she goes, the U.S., Canada, North America in general is supposed to be this big Christian country, and I think people forgot about God. And they need to go into these big churches that you see on every street corner because darkness is taking over, and we need to light candles and bring that light back out there,
Amen.
Esther, what are you thankful for? Amen.
Well, I mean, I love God. I love my kids. I love my clients and the business God gave me. And my fervent hope is that people see that politics is not important, but doing the right thing is, and vote.
Yep.
And spend some time thinking about what's the right thing for our country.
Yep.
Okay, what do we got?
Well, while we're talking about letters, Larry said, Esther, my dad just got a letter from the IRS saying that they have not received a return for him for tax year 2019, and that they have processed and
proposed
made their own return, and he owes around $15,000. He has two sources of income, his Social Security and a small pension in the amount of $275 a month. What should we do?
Well, for sure, they got other income than you know about, Larry, because there's no way that he could owe $15,000 in taxes on $275, because that pension is the only taxable source of income that you're telling me. So it's probably just like our last letter that somebody got a bill from the IRS. I bet you your dad moved around stock and you didn't know it, and so they probably have from the broker something that said that he sold maybe $100,000 worth of stock, and there's no cost basis because the IRS doesn't know, and so that's why he probably got the letter. So this is what I would suggest you do. Don't ignore the letter, even though it's probably wrong. But based upon what they have, it's correct. So just give us a call. Come on down to the office. We'll interpret this letter for you so that you know what it's talking about. And the other thing is, sometimes when we're dealing with elderly people, they're not aware of everything they did. Maybe they took money out of their out of their IRA for their RMD, and your dad didn't tell you about it. So the important thing is we first do discovery, find out exactly what the letter is pointing to, then we try to solve the mystery in the most tax advantage way as possible.
And the funny thing is it doesn't say on the statement stock sale. It's really hard to decipher. It's going to be a 1099-B, and so it's really hard for people because it doesn't say stock sale.
Yep. It could also be he's a senior. It could also be gambling. I mean, right?
And that's true. It's true. And,
I didn't get anything in the mail, so why was I? Because you got the yellow slips when you won, but I lost it all, too, so I didn't win anything. How many times have we heard that,
That's true. Right.
So there could be a lot of different.
Since the standard deduction for a senior is so high, many times if they lost $10,000 and they had gambling winnings of 10, and then they lost 10, they don't have enough to itemize, so the 10 still ends up being taxable.
Right. And I don't know how this would work, too. Either way, whether it's stocks, whether it's gambling, whether it's pension, this could almost impact his IRMA
Right.
for Medicare. And I don't know, would Social Security go back and collect all that extra Medicare money that he should have paid? I don't know how that works. That would
And
be...
Irma's just not a nice name ever of a
No,
lady,
Aunt Irma.
right?
No.
Right.
I don't want to go to
So,
Aunt
all right,
Irma's
explain
house.
what it is, though, Chris.
IRMA is your...
Why do they call it Irma?
It's your income-based for Medicare. So by what your income is determines how much you pay for your Medicare
But
insurance.
Irma is the beginning letters of this
Yes.
part of the law that says that this is income reclassification for Medicare assistance or something to that effect. That comes to Irma. That's the name Irma, right?
Yes. Yes.
Okay. All right, what else we
Income-related monthly adjustment
Oh,
amount.
thank you. I knew it had something to do with that. Okay,
Yes.
what else we got?
Chris, you want me to do it or you want to
You
do
can
it?
do it.
This is Connie. EG Tax. I have a large dental bill this year, $39,000. I can spread out the payments by putting it on a medical card. If I only have Social Security because I'm too young to withdraw from my IRA, can I take the medical deduction?
Okay, so all right, first of all, when you borrow money to pay for a tax deductible thing such as medical, and dental is part of medical, then it's deductible in a year that the debt is paid through your credit card. All right, so even though you're going to make payments over 5 years, the minute you signed on the bottom line, that made that dental bill deductible. That's number one. Okay, so she's got $39,000 in a deduction hanging out there. Now she's got a month to go. What do you think she should do? Because obviously she has IRAs.
She should take some money out of her IRA, tax-free basically.
Maybe she should take it out of her IRA and pay for her dental bill so then she doesn't have credit card debt.
So one option, so obviously she's got a 7.5% floor she has to come up against, but right now she has no income. She took $20,000 out of her IRA, assuming she's a single lady. She's still going to be able to itemize, and so that $20,000 that she takes out of her IRA is completely tax free. Now, if she puts it on that credit card, she's going to pay interest, which is not deductible. So, like Chris says, maybe you should investigate moving it to cash and taking the deduction and taking money out of your IRA. What people don't know is with that large standard deduction, you can, those of you that are living on Social Security and thinking you shouldn't take the money out till you're required to, sometimes that's not smart thinking. The smarter thinking would be to take the money now.
Yep.
You know, if you have that room in your budget, you know, because you would take it out for free. Everybody's talking about moving over to a Roth, and here they have, because of this big standard deduction, they have this big deduction that they can use to offset income that would have normally been taxable, but now is tax-free because you had the big deduction.
Yeah, and then also, you know, she can itemize her property taxes or maybe her sales tax,
Charity.
and mortgage interest. Yep.
Right.
So she has an opportunity, and she should call us at 632-7886, and we can over the phone give her some guidance further for her particulars, or she can come into the office too.
Right. And that way we can show exact. And the other thing is, this now we're officially kicked it off with the Christmas season, holiday season. You can buy deductible Christmas gifts too, right? I mean, like, let's say you're married to a self-employed person. You can get them new office furniture. I'm sure they'd be thrilled. Office chairs, new computer software, a cell phone, you know, used for
Laptop.
business, laptop, right? New maybe vehicle. We just bought a new box truck, right?
Yep.
That's not a Christmas.
Wait, I was going to
present.
say, wait, is that my Christmas present?
But if it were a smaller company and you've been hoping for that, that would be a wonderful thing, and it becomes a great big tax deduction plus a gift, right?
Right. Yep.
All right, let's go back. What else we got?
You got one?
Oh, yeah, I was
Chris?
going to say this follows up with what you started saying in the other one. Mike writes in, EG Tax, my broker said I should consider moving about $50,000 to a Roth IRA from my 401k. He said that won't make me jump tax brackets, so it's a win-win. What's your opinion?
Well, I mean, you may not jump tax brackets. You just might pay 20% at the tax bracket you're in, which is $10,000. You have to take a look at whether you are going to stomach the taxes you pay up front, because when you move it from a traditional to a Roth, you're going to pay the taxes now. It's true you won't pay them later. You're just going to pay them now.
Right. And, if all he has is his 401k, he may go down tax brackets. So right now he may be in the 22% bracket
I mean, when he
retires.
When he
Right.
retires.
Yep.
Right. So it's not clear cut. Everybody's different. You got to take a look at everything. And many times when people start looking at moving from a traditional to a Roth, they say, "Oh my gosh, the taxes up front are not worth it." And remember, it's taxes up front. Anyway, we're going to take a short. I'm Esther Gilius, the tax lady from EG Tax. We're going to take a short break for the news. Thanks for listening. Happy belated Thanksgiving, and we'll see you on the other side. Hi, I'm Esther Gilius, the tax lady from EG Tax. To us, you are family. And family, we only got a month to go till it's 2024, just about. So we want to help you. And so today we're doing emails because we can really go into more depth when we have emails as opposed to live phone calls. But next week we'll be back to the live phone calls. So what else we got, guys?
Norma says, tax lady, my mom gave us her house after Dad passed away. Now she's living in the house with family taking care of her. Unfortunately, she only has a short time to live. If we sell the house after her passing, will there be any tax consequences? If so, how much? Can you explain?
Well, the reason that people usually give away their home is in anticipation of going into a nursing home, because the cost of a nursing home is so expensive, and she probably had thought about going on Medicaid. Well, obviously, this being the end of her life, she never did go on Medicaid, right?
Correct.
Because she's living in her home.
Yeah.
So what would you guys think that she should do? Because what would happen if they did sell it this way, with them being on the title before her death? They're going to have to pay taxes.
Well, yeah, I would
game.
first ask Norma, was this a gift, or did Mom put it in a life estate?
Well, it sounds like it was a gift. Let's go with both. So let's say Mom gave it to them as a gift.
So then their basis, Norma and what other siblings there are, become Mom's basis.
Original.
Well, it gets a little confusing because
Right.
Dad passed
Dad,
away.
and repairs and things.
Right. So you have to go see what Mom and Dad paid it for, what improvements were done prior to Dad's death, and that becomes, take half of that becomes Mom's basis. Then Dad's half, Mom inherited, so what was the value that when Dad died, take half of that, add those two figures together, and now that becomes Norma's basis. I know it sounds very confusing, but that's tax law.
But the thing is, maybe there was never a dad, or maybe he passed away.
20 years ago.
Right. But anyway, the bottom line is, if it's gifted, then it goes back to the donor's basis. Okay.
Right.
If it was a life estate or went through inheritance, then you get a stepped-up basis, the fair market value of the date of the person that's giving the asset is a fair market value at the date of their death. So that's a higher basis, so the gain is almost nothing. But here's an interesting thing. What if they put the house back in Mom's name now, before her death?
Well, then you got to be careful, because if Mom goes into a nursing home,
No, Mom is terminal.
I know, but she's still.
I mean,
I
if
agree
she's
with
terminal
Esther.
and they're going to take care of her, right?
Yep.
Then she's not going to go on Medicaid, and they're not going to lien her house. And what happens in that case? If it was a gift, So if it was a gift that she gave to the kids and they're going to end up having paid taxes on a $200,000 gain, for instance, and she only has a short period of time to live, if they put the house back in her name,
And they inherit it.
then they would inherit it, and then they get the stepped-up basis, and they would save like $40,000 or $50,000 in taxes, right?
Ding, 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 ding. I think that's a really good
But I mean,
solution.
that's the third way to look at it.
Yep, absolutely. I think, it's really
And of course,
complicated.
Mom lived in the house, so it's completely tax-free anyway, if they should sell it before her passing.
That's right.
Yep.
Okay. All right, what else we got?
Chris, you got one, or you want me to?
Shannon writes in, Esther, my business this year is looking like I should have a profit of $25,000. How much money should I keep aside for taxes? My husband makes around $95,000 at his job, and we have 2 children who are 12 and 15.
So you still have time, Shannon, to do something to reduce that overall net profit, right? I mean, because as long as the tax year is still open and you're self-employed, it sounds like she is self-employed, then she can buy something that, for instance, that she might need in the business and take a big write-off for it right now. For instance, like maybe she needs new office furniture or a new desk, or she needs a new vehicle or a box truck, right? I mean, all of these things reduce your profit so that you pay a lot less in taxes. So that's the first thing I'd look at to reduce the tax liability. But aside from that, then she's got FICA and income taxes, right?
Right, which would be about $6,500 for the federal, and that's not to mention New York State figures 6% of $25,000, so that's another $1,300 for New York State. So,
But of course, she's got the 2 kids, so she's got a built-in credit of $4,000 because of those kids, right?
Yeah.
And the other thing is, she can put money if she's a sole proprietor and no employees, which she doesn't tell us. But she can do a solo 401k if she wanted to,
That's right.
right?
Yeah, I was thinking about that.
And so she could get rid of almost all, if not all, of her net profit, so she wouldn't have to pay income tax on that, just FICA. So there's a lot of options. So what I suggest Shannon do is give us a jingle, and we can explain it all to her, because you've only got a month to go.
Yeah, and then probably I'm thinking maybe her husband covers the health insurance, but if she had to pay for health insurance, there's also a deduction for a self-employed person who pays health insurance. And then hopefully she's kept good track of all of her expenses. Mileage is always something important, and cell phone, so money in, money out,
Right, and maybe she's working at home, and she could have she has an office and home. All of those things, especially. And the other thing is, I know we have laptops that we can walk around from room to room to room, and that's great that you want to work on your couch in your living room. But unfortunately, you're really messing up a deduction. Isn't that true, you guys?
Yeah, your office and home. Yeah, absolutely. Because you have to have a room that you solely and exclusively use as an office. It can't double as a bedroom, and so people.
And so if you have an office and home, the percentage of the square footage of your solely used office and home is then divided by the square footage of the house, and therefore a percentage of your interest paid on your mortgage, insurance, repairs, property taxes, utilities, all go into the office and home. But if you're working on your laptop, wandering around the house, then you don't qualify for that deduction. So sometimes it's just changing your mindset, and you say, you know what, I'm going to start working exclusively in this room, and therefore then you create another deduction.
Yep.
right, and the room's got to have 4 walls and a door. That's the IRS's description of an office and home. So a living room won't count because there's no door. Too.
Well, you had to get into it somehow. Right? I mean, you don't float in through the ceiling.
Well,
what
but
I'm sure
there's
that
an entryway, but a door is a door. And how many living rooms actually have a physical door to get into their living room?
Correct.
not
Correct.
gonna go
Correct. Correct.
Okay. All right.
You guys, ding, ding. Go back to your corners.
What's another question, Tiff?
Kevin says, Esther, what is the difference between ordinary and qualified dividends and then capital gains all being reported on a 1099 DIV? I'm very confused, he said.
Well, people think, people say, oh, I got to pay capital gains. You guys have heard that, right?
Yeah.
Oh, man, I got to pay capital gains. Is that a bad thing?
No, it's taxed at a more favorable rate.
It is. Capital gains are treated with kid gloves in the federal government. When you invest your money in the stock market or any capital asset, they tax you at a maximum of 20%, even though you might be in the 36% bracket. So it's a 16% savings. That would be if you are a higher income person. But if you're a lower income person, you might pay 0% on capital gains.
Yeah. Yeah, it's so funny. We did a seminar not so long ago, and I was with a guy for like 30 minutes, and then Dana was there. She was with this gentleman for maybe an hour and a half, and he was doing his return by hand, and he was so confused that he was in the 27% tax bracket because there is no 27% tax bracket, and so beating our heads. And so what he was doing is he was taking the two buckets. He was taking his ordinary income and his capital gains, and together it was 27%. But I don't know. What was Dana's? Dana was with him for hours. What was the final breakdown?
Oh, he never really truly understood because he's like, but if I take out $1,000 more, this figure goes up by $270, and trying to explain to him that's because more of your Social Security is taxable and different things.
And that's what makes taxes so hard, is because it's true that capital gains might be taxed at 0%. However, even though you're not paying income tax on that, the taxable income goes up, which could make your Social Security go up. So even though you didn't get any more income, your Social Security could become more taxable.
Yeah.
Until it gets to 85% of the Social Security, right?
And so
Anyway, so the difference between qualified dividends, it means that they qualify for special treatment. They're not taxed as ordinary dividends at the regular rate. So your wages are ordinary, interest is ordinary. Ordinary dividends are taxed just like wages, but when you have qualified dividends, they're taxed as if it's a capital asset, and you get preferential treatment.
And
that's to go back to the
right.
original
And your qualified, though, are already in your ordinary. They're not two separate dividends you have to record on your tax return. The ordinary comes first, and then they tell you out of that ordinary how much is qualified for the cheaper tax rate.
And then that computation is done on the Schedule D worksheet. And so many people that are doing it with pen and pencil, they look at that and say, oh my gosh, I don't want to do this. And so they don't. And so they overpay.
And then you guys are going to have to help me because my brain's not firing right now. Also, on many of the dividend statements, there's the deduction, the Trump deduction for that's on the bottom
The
of
199A.
That's a 199.
Yeah, the 199A. So don't forget also on that dividend statement or the
You
brokerage.
save 20% on that too.
Yep. So don't forget to look at that. That will lower the taxable income as well.
And foreign taxes possibly are being paid there as well. So there is a lot more than just those three. You really got to take a look and see.
Yeah.
Right. And so if you have your brokerage statement, take a look at it right now that you have time at last year's and see if you don't have a 199A breakout, and if you have foreign taxes paid. If you have either of those or both of them, you save 20% on the 199A as a deduction, and you would get on the first $600 in foreign taxes paid. That's a direct credit as well. So those are things that would save you money.
That's right.
Right?
Yep.
All right, I'm Esther Gulius, the tax lady from EG Tax. I'm here in studio with Tiffany Fabian, Christopher Fabian. If you hear something you like, please give us a call. We want to help you, to us, your family. And speaking of that, we're going to take a short break, and we'll be back on the other side with your emails. Thanks for listening. Hi, I'm Esther Gulius, the tax lady from EG Tax. To us, you are family. Thank you for listening, and thanks. I'm thankfully that this is the Thanksgiving holiday season, and we're so thankful for you too. And remember, we want to help. Okay, we're answering emails today. What else we got?
Ned says, tax lady, I'm 72 this year, so I have to take my money out of my IRA. How do I know how much? I just put in $7,000 from my job last year. Do I take it all now? Seems stupid to get the deduction and then make it taxable. Ned.
A lot of people think that. They think if they put money into an IRA and then they have to, then they have a required minimum distribution, then they are forced to take it all out. It doesn't work like that. But there's something that I noticed in that email. He says he's 72.
Yeah.
And so what does that mean?
He's got another year.
Right.
It's 73, and it's going to go up to 75 for the required minimum
so,
distribution.
So right now, his name's Ned?
Yep.
So, Ned, you got a whole year. You don't have to take money out of your RMD. Starting next year, you have to take money out of your required minimum distribution. And not only do you have till next year, you actually have till April the 1st of 2025.
Yep. You can
Right?
take
Because
out.
in your first year of your RMD, they actually let you slop it over till April the 1st.
Exactly. And not to mention, he
and then,
might.
and then the divisor, right? So when you're doing your RMD, you take a look at all of the plans that require you to take the required minimum distribution, and in many cases you add it all together and divide it by 27.5. That answer is the amount that has to be taken out. So if you had $100,000, once you have to take the money out, you only have to take out $3,636. So
Yeah, and then not to mention, he doesn't have to take it out, but maybe he stopped working this year, and so maybe there's
Right,
room
that's true.
that he could take it out.
Just because you aren't 73 doesn't mean that you wouldn't want to take it out.
That's right.
Because if you have high standard deduction and you're not paying any tax liability, taking it out means you get to take it out tax-free.
Yep,
And if you don't know what we're talking about, call us so we can explain it.
exactly. Take advantage of tax law if you can, because using wisdom and being wise is a good idea.
Right. All right, what else we got?
Don and Jody says, Esther, we just moved from Buffalo to Charlotte. When we sold our house, the buyer did not want our furniture, not their style. So we donated it to charity. The charity said the furniture was worth $30,000. Will this help us tax time?
Well, yeah.
Yeah.
How? Explain it.
Well, because as long, it sounds like the charity gave them an appraisal. So then that charity, that is a charitable write-off on your Schedule A, on your itemized deductions. So you can use that $30,000 plus any property taxes you paid, mortgage interest, if you hit the medical, and that will help reduce your income. And
Now, because it's more than 5,000, there's something special they need to do, right?
right there's the Form 8332. Is that?
And you have to attach, if the value is non-cash, then you have to attach a copy of the appraisal, right?
Right.
So you want to make sure, Don and Jody, that you really do have an appraisal. It's not like the director of the charity walked through and said, wow, this looks like it's worth $30,000, because that's not an appraisal. You want to make sure that if you're taking this deduction, that you have a written appraisal that'll stand up to IRS scrutiny.
Correct.
And the other thing is, well, let's say that they only paid 20 for it.
Mm-hmm.
Then
Then they
What's the gain?
no,
then
they
what?
still get the 30,000. They get the appreciated value.
And if you gave appreciated stock, same thing, right? I mean, like for instance, we're talking about charity, whenever you give an appreciated asset, you get not only the charitable deduction, but you get the fair market value of the asset when you gave it. So if you had ABC stock that you paid $5,000 for, that's now worth $40,000, you can give it to the charity, take the whole $40,000 deduction, and not pay taxes on it,
That's
on the
right.
gain.
Yep.
Right? I mean, that's a big deal.
Right. And then definitely you want to keep track of all your other charity that you did throughout the year, because then that gets added. So it's, it's a great thing.
Right. And the other thing is, we're talking about charity. let's say that you're somebody that's has to take an RMD distribution out of your IRA. What else can they do to reduce that taxable distribution, taking money out of their IRA?
They do a QCD, a qualified charitable distribution, which is when the money goes directly from the IRA to the charity. It does not touch your hands. This way,
so therefore, then what happens?
then say your minimum distribution was $10,000, you gave $4,000 to charity. The only amount that gets taxable on page 1 of the 1040 is $6,000.
And if you gave the whole $10,000,
Then nothing gets taxable.
and if you gave $30,000,
out of the 10?
no, if you gave 30, I mean, you can do this up to $100,000.
Correct,
Is what
correct.
I'm getting to.
Yep.
So, people that are givers this time of year, time of giving. And the other thing is, you talk about time of giving. So you can give on your RMD if you do the direct qualified rollover up to $100,000 out of your IRA. But other things that you might be giving, maybe you want to give clothes to charity. Keep really good track of what you gave and the fair market value of the date of the donation. And again, if it's over $5,000, you have to have a written appraisal.
Correct.
Okay, what else we got here?
We have Alex, EG Tax. I just bought my first home. What do I need for my taxes this year? Is there anything special I should save?
What do you guys think?
Yeah, so you're going to get a closing disclosure, and so you want to save that closing disclosure because maybe there's some points that you paid at closing,
Which probably is coming back now because mortgage rates are increasing.
Yep,
Right?
absolutely.
So let's talk about what points are.
That's to secure a lower interest rate, Chris.
Right. So you pay interest in advance. So you're giving the bank some money now, so you're not paying a whole bunch later.
And for that, what are they doing?
They get a tax deduction on their tax return.
It sort of holds that interest rate.
Well, it reduces the overall interest rate. Right?
Yep, exactly. That's right.
Because that's why you're doing it. So they say to you, all right, John and Mary, our interest rates are 8%, but if you pay 2 points, we'll drop it down to 6%. And so basically you're buying down on the mortgage interest, and that makes it deductible.
Yep. Yeah, and then also there may be some interim property taxes that they paid. And so on that closing disclosure, you can pick up those things, the mortgage interest, the interim property taxes. You can no longer deduct PMI, mortgage insurance. And also for the next a year or so, it's really harder to itemize, especially if you bought the house later in the year, you're not going to have as much mortgage interest. Now, if you bought the house earlier in the year, the mortgage interest may have picked up more speed and you'd have more mortgage interest to deduct. But always important to also look at your 1098, which will have that mortgage interest and property taxes on that 1098 statement. And then also be careful. A lot of people get a mortgage and then it's sold like a month or two later. So it might be a broker who started the mortgage, like
Chase, and then
Chase.
it gets sold to Freedom, and then it gets sold to somebody else.
Right.
That happens a lot. But also, then don't forget, if you had to do new windows, a new door, insulation, any energy improvements, a new furnace, that also can save you some money on your tax return as well through energy credits.
Right, and again, you got 1 month to do those things too, and that can save you $1,200 and $2,000, so maximum of $3,200. That's a big tax deduction credit. Right?
Yeah, and then just to use a personal example, my daughter is buying a house with her significant other, and so who should take the mortgage interest or the property
And that's
taxes?
very important. Usually, it should not be split.
That's right.
So it should be allocated to one or the other, and usually it's the person with the higher income.
That's exactly right. So you just want to play with the numbers and see which way yields a better answer. I know when I have a client come in, I'll always write it down, mortgage interest split, mortgage interest to him, mortgage interest to her, and we see which way yields a better answer for the family.
Okay, so let's quickly do another one here.
Alex, hello, that was Alex.
Oh, did we hire
Mike, EG Tax. My broker said I should consider moving about $50,000 to a
We did that
Raw.
Oh, we did that one.
Okay, I'm looking to sell one of my rental properties this year. I'm hoping to get $200,000 for it. Bought it in 1995 for $125,000. I'm thinking of keeping around $10,000 for taxes. Do you think I'm in the ballpark? Is there anything else I can do to not pay taxes?
Well, if he did a tax-free exchange, if he did a 1031 exchange, he would just move from that rental to another form of investment, real estate, and that would defer the taxes altogether. Otherwise, his basis, and I don't know about all the other things that might be hanging out in his depreciation schedule, but it looks like his basis should be almost zero.
Right.
So,
So he would pay
even
tax
though he bought
on the
it for
whole.
125, he's written off the 125. So if he's in the, you're looking at 20% maximum, it's like 40,000 in taxes.
Yeah,
Right.
and not to mention New York State.
Right.
So
And now this is reduced by any last-minute repairs you did this year, the cost of your brokerage commissions, and all the other closing expenses as well. But you're probably, and like Chris says, doesn't include New York State, so you're probably way off, maybe 50,000, if these are the right numbers. But I'd suggest you give us a jingle so we can see what you actually are going to be stuck with. And you might want to do the 1031 exchange. Now, if you've already sold it and you've gotten the money in your hot little hands, then it's too late. But prior to sale, as long as you do the 1031, like exchange for like exchange, you can defer the taxes.
exactly. Yep. Yep.
Okay, we got room for one more?
No.
Nope.
No, we don't.
10 seconds.
Oh, well. Okay. Well, I'm Esther Gillies, the tax lady from EG Tax. We'll talk to you next week. Thanks for listening, and thank you for being our clients and our listeners. Have a great day. Go Bills. Bye-bye.